Good afternoon, everyone, and welcome to the latest in 39 Essex's series of banking and financial services webinars. Thank you all for joining us today. Before we head off on holiday and get the buckets and spades and get to the beach, we thought we'd talk to you today about the cheery topic of FCA enforcement. We've provocatively subtitled that an expanding jurisdiction. I think there was meant to be a question mark to the subtitle, that seems to have disappeared. I'm going to be joined by my very talented colleagues, Rebecca Drake and Ben Tankel. You'll see an empty chair next to me currently. Ben is currently rushing back from the Royal Courts of Justice, but he promises he will be here to speak after Rebecca. But in the meantime, I'm going to hand over to Rebecca to speak to you about the FCA's naming and shaming policy.
Hi, I'm Rebecca Drake. I've just introduced myself quickly. I've been in Chambers for almost 20 years. And I have a broad commercial practice, and I do quite a lot of civil fraud and financial-based cases. So I'm going to give an update on the FCA's proposals for greater transparency when carrying out enforcement investigations. So we've named that section Updating the FCA's proposals for greater transparency when carrying out enforcement investigations, naming and shaming. And first of all, I'm going to, let's see if I can move the slides on. There we go. I'm going to give an overview on the updated enforcement guide, which came out last month in June. And then I'm going to talk about the key changes to the investigation publicity policy. The two main ones are maintaining the exceptional circumstances test for publicising investigations, which is in section 4.1.4 of the updated enforcement guide, which I referred to as ENFG. That's what the FCA call it. And then we'll look at three additional circumstances where investigations can be publicised for increased transparency. And those are all set out in the enforcement guide at 4.1.6, 4.1.7 and 4.1.8. So having a look, first of all, at an overview of the updated enforcement guide. As I said, the update came out a month ago. The FCA first published its enforcement guide in 2007, and the guide has grown significantly since then. The most recent one was 300 pages long, and this one's 159, so it's significantly streamlined. The FCA consulted on its proposed measures to update and streamline the enforcement guide, and specifically to increase transparency. The consultation was by way of document CP24-2, which came out in two parts. The FCA received extensive feedback from stakeholders, and those stakeholders included industry groups, consumer organisations, and parliamentarians. There were 133 responses to the first part of the consultation paper and 65 to the second. And they also held 40 roundtable discussions. And actually what came out in the enforcement guide was quite different from what they originally proposed. So the key features of the enforcement guide are increased transparency, and that's really what we'll be looking at today, and also increased speed of investigations. The FCA had said that it recognised its average investigation times were too long, and says it has significantly accelerated its investigations. Now, the reason it wanted to update the investigation publicity policy and increase transparency was because the previous policy was first issued after public consultation back in 2001, and the policy had been almost unchanged since then. And it meant that the FCA rarely said anything about its investigations until they had ended, to the extent that they wouldn't even ordinarily confirm the existence of an investigation, even where the firm itself had made that public. And in 2022, the House of Commons Public Accounts Committee made a recommendation that there be an increase in transparency to serve the public interest following the investigation into the British Steel pension scheme. Now, by proposing to give more information about its investigations at an appropriate moment in time, the FCA set out 5 aims, which were firstly to protect consumers by educating them about worrying conduct, enabling them to act, helping to prevent harm or reduce harm more quickly, Secondly, to support public confidence and trust by reassuring consumers and market participants that they are taking appropriate action. Thirdly, to drive positive behavioural change. This is to be clear about the types of misconduct they think warrant an investigation, and thereby allowing other firms to learn lessons and raise their standards sooner. So it's a bit preventative. Fourthly, to improve their accountability, particularly as the FCA is regularly asked about specific investigations by parliamentarians and their committees. And finally, to support investigations by increasing transparency to help encourage witnesses or whistleblowers to come forward. In terms of implementation, the revised enforcement guide and the related policies took effect on the 3rd of June 2025. The revised policy applies to all of the FCA's investigations started on or after the 3rd of June 2025 by way of statutory appointment of investigators under FSMA or otherwise. So if an investigation had started before then, the old policy will still apply. The FCA has said it will monitor the impact of these changes through surveys, stakeholder feedback and data analysis. And it said that it will continue to consult on all future changes to the enforcement guide to ensure transparency and stakeholder engagement. Now, looking at the changes, the first change is that it will maintain its exceptional circumstances test for publicising investigations, although it has introduced 3 additional circumstances where investigations can be publicised, and we'll have a look at those in a minute. Now, this is important because the proposal had been to introduce a new investigation publicity policy in which the exceptional circumstances test would have been replaced with a public interest framework. Now, there was strong opposition to that. The stakeholders and people responding to the consultation paper felt that firms or individuals would no longer be innocent until proven guilty. And although the consultation feedback showed there was broad support for increased transparency, people were very concerned about reputational risks and market impacts of naming regulated firms under investigation. So the proposed changes aim to balance out the transparency with those concerns. So I've put on the slide the text from the enforcement guide at 4.1.4, and it reads as follows. Where it's investigating any matter, the FCA will, in exceptional circumstances, so this is what the test is named after, make a public announcement that it is doing so if it considers that such an announcement is desirable to 1, maintain public confidence in the financial system or the market, 2, protect consumers or investors, 3, prevent widespread malpractice, 4, help the investigation itself, for example, by bringing forward witnesses, or 5, maintain the smooth operation of the market. And the FCA has said that in deciding whether to make an announcement, it will consider the potential prejudice that it believes may be caused to any persons who are or who are likely to be a subject of the investigation. I'll just move on to the next slide, which sets out the first of the 3 exceptions. The first is 4.1.6, and this is naming subjects of investigations into suspected unauthorised or criminal activities. I haven't put the whole text on the slide because it's quite long, but I've put a summary of it and I'll go through it. So first of all, where the FCA has investigated suspected unauthorised activity, it's a key part, or suspected criminal offence in relation to an unregulated activity, there are often concerns around consumer harm. And the FCA generally has no supervisory, intervention or oversight powers to protect relevant consumers. The FCA has therefore said it may make public that it's investigating a named person for suspected unauthorised activity or for a suspected criminal offence in relation to an unregulated activity if it considers that would be desirable for the purpose of warning or alerting consumers or investors, or to help the investigation itself, for example, by bringing forward witnesses. And again, it's quite repetitive. In deciding whether to make an announcement, the FCA will consider the potential prejudice it believes may be caused to any persons who are or likely to be a subject of the investigation. And the FCA has also provided a new glossary definition of unauthorised activity, which is any activity in breach of Section 21 of the Act, that's FSMA 2000, or carried out in breach of a statutory requirement for authorisation by or registration with the FCA or PRA. And Section 21 of the Act deals with restricting financial promotions by unauthorised persons. The second of the three exceptions is the confirmation of investigation where that is already known, where that has already been made public by other entities. And this is something the FCA was really concerned about, that it couldn't do before. So the FCA has said that it will be able to reactively confirm and publicly confirm that they're investigating a subject if they, an affiliated company or regulatory body, government or public body in the UK or partner jurisdiction has or have already made that fact public. Now, it's really important that this is a finite list of bodies. So it doesn't include on that, for example, a tabloid newspaper. So the FCA's investigation announcement may also confirm the nature of the investigation as far as that's already been made public. So if the name but not the nature has been made public, the FCA will only be able to confirm the name and vice versa. The FCA has talked about the form in which they share information, and it hasn't been particularly definitive on that, but it's given examples. So it said they might make a brief reactive confirmation statement via the website. And they've also said that they're exploring other ways of sharing information on a general basis. So they're considering whether they might show announcements on their register, whether they might show announcements on their warning list, and their recently launched firm checker facility. And finally, the third of the three exceptions, which is probably the least controversial because it's anonymous, is the ability to share anonymised information. So the FCA has said that it will be allowed to make public that they're investigating a particular matter on an anonymised basis without naming or identifying the subject of the investigation. And it might do that where it's desirable to educate people generally about the types of conduct they're investigating, or to encourage firms to comply with their rules or other requirements. I think it will be really interesting to see what will happen in practice, because to date the FCA has only really used exceptional circumstances in a few cases. But in light of the fact that they have discontinued their new proposals, which are more wide-ranging than the ones that have actually been adopted, it'll be interesting, I think, to see whether the FCA starts to use and potentially test the boundaries of the exceptional circumstances test instead. I'm going to pass on to Ben now. He's fresh from court and is going to talk about his section.
And my things next. They are excellent. I am talking about non-financial misconduct, which the FCA interprets to mean bullying, harassment, and discrimination, but we will see in a minute that it can also include a whole panoply of other exciting things. Now, what I want to do is tell you a story in keeping with the theme of this webinar as to how this started small and how it's grown and grown and grown in terms of the imperial jurisdiction of the FCA. And we start with section 64A of FSMA, which provides that the FCA's conduct rules can only relate to the conduct of persons in relation to the performance by them of qualifying functions. So it can't look into your personal life, although it has always been accepted that questions about fitness and propriety is not limited in that way. The big first case on this was the case of John Frensham. John Frensham attempted to meet an under 16-year-old for the purpose of sex. And he got a criminal conviction for that. And importantly, he did it while he was already on bail for a different matter. Now, I think a lot of us might have thought that's pretty problematic. The FCA, from a professional point of view, the FCA decided to remove his authorization. But he argued on appeal that this just happened in my personal life. I agree that it's bad and it was a criminal offence, but it's got nothing to do with my professional standing. And you can see what the upper tribunal found. They actually agreed with him to an extent, that this was something occurring in the person's private rather than his personal life. And it had to be something that engaged the standards of behaviour required of the individual concerned by the applicable regulatory provisions. And this is key. It's not simply a question of assessing whether the behaviour concerned demonstrates a lack of integrity at large. You have to consider whether this disgraceful behaviour engaged these specific standards laid down by the relevant regulator. It's something that had to be able to be relatable back to the context of providing financial services. And the upper tribunal found that it wasn't satisfied that Mr. Frensham should have been given a prohibition order solely by virtue of his conviction, however disgraceful that conviction might have been. Where Mr. Frensham really went wrong, at least from a professional point of view, was to breach his bail conditions. Now, why is that problematic from a professional point of view? Well, first of all, none of this had any connection to consumer protection. The upper tribunal found that integrity did embrace questions of public confidence in the financial services industry, and that had been harmed, although there was no sufficient evidence as to the extent to which it had been harmed in Mr. Frensham's case. But this is what it felt able to say regarding the breach of bail conditions, that Mr. Frensham took a deliberate decision to disregard the law in order to satisfy his own interests. And rather than listen to his probation officer, he made his own judgment that it was appropriate to go and meet this under 16-year-old girl. And those were matters which bit more closely upon his responsibilities as a provider of financial services. So we can see the limited and constrained way in which these sorts of issues first started to break their way into questions of financial regulation. The next part of this story is a FCA letter to the Treasury Select Committee from July 2023. And you can see what it said. This is a comment on the Frensham decision, that the upper tribunal's decision demonstrates the challenge we may face banning people relating to sexual misconduct alone, even when criminal convictions have been secured. That the FCA felt differently from the upper tribunal. We continue to consider that such misconduct can, of itself, create a sufficient risk to our objective such that it should result in a prohibition. It wasn't happy with the upper tribunal decision. Continuing in its letter, it gave a précis of the statistics to that point. We've publicly prohibited 7 individuals for non-financial misconduct of various kinds: sexual assault, possession of indecent images, voyeurism, serious assault, non-payment for railway tickets, and use of work email to send inappropriate messages. We'll see a few of those examples in more detail on the next slide. But all but one of those cases involved a criminal conviction or caution. So small numbers, criminal conviction or caution is going to escalate you into prohibition order territory. And that is where things stood in July 2023. And here are just a few of the examples. It was Jonathan Burrows, who was dodging rail fares by tapping out but not tapping in. Paul Flowers, the chairman of the Co-op Bank, who was using work devices for inappropriate calls, and John Frensham, we've already discussed. But interesting that seniority is no safeguard against any of this. In October of 2024, the FCA conducted a survey of about 1,000 institutions regarding their non-financial misconduct, grievance and complaint statistics. And in its foreword, it provided a rationale for why the FCA was starting to get interested, or was continuing to become more interested in this area. And really a justification for why this is a matter of regulatory interest for the FCA. A corporate culture that tolerates sexual harassment or other non-financial misconduct is likely to be one in which people feel able to speak up and challenge decisions, or one in which they will have faith that concerns will be independently and fairly assessed. Such a culture also raises questions about a firm's decision-making and risk management, and by contrast, a toxic work culture is one in which people are not going to do those things. So a strong connection between just the workplace environment and regulatory matters. There's a graph, and you can see the direction in which institutions, NFM, non-financial misconduct grievance and complaints were moving between 2021 and 2023, big increase. And also in the survey, we can see examples of the types of non-financial misconduct that firms were coming up. I think this is helpful because misconduct often happens in very similar ways from institution to institution, from profession to profession. And you can see the list there of things that aren't necessarily bullying, harassment, or discrimination, but which might also come under the heading of non-financial misconduct. In January 2025, the FCA wrote a letter, Dear Chief Executives, to wholesale banks, to brokers and to insurers regarding remuneration rules and non-financial misconduct. And sets the expectation that remuneration too will be used as a disciplinary tool to broker misconduct, including non-financial misconduct. And then this second part of the slide is a clue to the sorts of matters that the FCA will be looking into when it comes and considers whether firms are complying with these duties. We will scrutinise policies and procedures. Are firms encouraging a good speak-up culture? Management of NFM cases by firms once they are reported, and processes for ensuring that fair outcomes are reached. Those are the things one has to get right in order to satisfy the regulator, should the regulator come knocking. Most recently, on the 2nd of July 2025, the FCA has published a consultation paper on tackling non-financial misconduct in financial services. There's going to be a change of the rules. So rather than having non-financial misconduct dealt with by way of whether someone's fit and proper or questions of integrity, which are nebulous, we now have, and it's not going to win any Nobel Prizes for literature, but we now have a promised change to the handbook, which will set out the rules on non-financial misconduct in much more detail. But the consultation remains open until I think the 2nd of September, maybe the 10th, we'll come on to it, it's on the slides. And the rules are supposed to be introduced in September 2026. And again, from the foreword of that consultation paper, we see the same rationale, mixing or explaining the FCA's interest in non-financial misconduct by reference to toxic behaviours and how that can impact on the way of governance more generally. So there you go, the consultation closes on the 10th of September. It's going to amend COCON as from the 1st of September 2026 for a whole range of institutions, so check carefully whether yours is included. And here is a definition of non-financial misconduct that is coming down the line. Oh, how do I go back? Maybe I can't.
Oh, if you scroll the mouse wheel up, it should work.
Okay. Unwanted conduct which has the purpose or effect of violating someone's dignity or creating an intimidating, hostile, degrading, humiliating, or offensive environment or violence towards a person, and it has to be serious and work-related. And then there is a whole set of further rules about what's serious and the factors to take into account in deciding that something is work-related. See the rules there. I didn't want to copy them onto the page. They're very long and technical, as you might expect. Continuing in the consultation, isolated point, but worth knowing. We would make it clear that a custodial sentence, even if suspended, is likely to indicate that misconduct in private life is sufficiently serious to be relevant to fitness and propriety, subject to certain other considerations. How old is the offence? How long was the custodial order, and so on. So And that means if you are a provider of financial services and you are unfortunate enough to incur a custodial sentence, which can happen for any number of reasons, some more closely related to financial services, some not, the FCA is almost certainly going to be interested, and to quite a serious degree. Potential sanctions for non-financial misconduct include the usual prohibition orders, fines, and career-ending reputational damage, seen all too often in such cases. It can be tempting to want to enter into a settlement agreement, including a non-disclosure agreement, in relation to non-financial misconduct, bullying, harassment, and so on. There are certain limitations on doing that, and I should say that the mood in relation to NDAs is very much anti. So don't be too keen on, or think very carefully before entering into an NDA to try to deal with an issue of harassment, bullying, and so on. I couldn't not do this talk without discussing the recent case of FCA and Jez Staley, former chief executive of Barclays Bank, who was a friend, it was so found, of Jeffrey Epstein, but told the FCA in response to an inquiry that he wasn't. There are far gorier details in the 500-odd paragraph judgment that the Upper Tribunal produced. Read at your leisure. But I wanted to focus on this. Mr. Staley had been asked by the FCA what was the nature of your relationship, and he sent off an email that said not very close one. Mr. Staley faced a difficult dilemma. Either he disclosed to Barclays the true nature and extent of his relationship with Mr. Epstein, which would be likely to result in an investigation and a risk to his career, or he could take the risk that the authority would be misled by the statements which he approved in a letter. Why have I included that? Well, integrity, hard to define, but it is that thing which, when a professional is faced with a dilemma of this kind, moves you into, I'm going to do the right thing rather than the wrong thing. And I thought that was an excellent description of that moment when a professional is facing a dilemma. Mr. Staley jumped the wrong way. I'd encourage everyone to not do what he did. Some practical advice, and then I think I can hand over to David. Bad apples are a fact of life. There will always be sexual predators and bullies and racists. It's very difficult, unlike possibly other areas of financial regulation, to mitigate for such people. However, at a firm level, foster a speak-up culture. Easier said than done, but there's plenty of steers from the FCA that is what it expects. Always be open and transparent with the regulator. If a matter comes up, don't do what Jez did. Just openness helps so much. It helps the regulator, it helps public confidence. It's an important factor in mitigation if any misconduct has occurred. Note the areas we've already discussed that might fall within non-financial misconduct. It's not just discrimination, harassment, and bullying. It's a whole range of things, including convictions, alcohol misuse, and so on. Get ready for the changes to COCON. That speaks for itself. Have policies and training in place so that you can point to those. It's a good idea to, where misconduct arises, pursue internal investigations, do so without fear or favour, pursue disciplinary procedures, even if that means dismissal. But if a firm can point to having responded thoroughly to such issues, then that is also an important factor when the FCA is deciding about matters of compliance. Read across from the SRA. There's not that much learning in terms of non-financial misconduct for financial services providers. There's lots and lots of it from solicitors, and there are plenty of indications that the FCA, the Upper Tribunal, and so on, regard the responsibilities of a solicitor, at least for these purposes, as being similar. And there's lots of cross-references to SRA guidance and cases and things in all of the documents that we've been discussing. And finally, an important point, the impact on mental health for both the victims and the accused. In almost every case where someone is accused of especially sexual impropriety, it is incredibly, or can be incredibly damaging to their mental health, to their family life. Just note it and be careful about it and take appropriate advice from occupational health or human resources and so on. But don't be surprised if mental health issues are raised in connection with these. True, of course, also the victims. And be ready to deal with it if it arises in an appropriate way.
Thank you very much, Ben. I am David Hopkins. I'm a barrister here at 39 Essex. I've been here for about 10 years now. I'm something of a poacher turned gamekeeper, having spent 5 years prior to that on various trading floors across the city. And I'm going to take you through some trends and significant decisions in recent FCA notices. And my conversion to being a lawyer is complete because that sample size would never have been considered sufficient in my whole career to draw any kind of trends from or anything like that. But now that I'm a lawyer, I will attempt to do so from the relatively slim number of notices we've had so far this year. As you'll see on the slide, we've actually not had any warning notices so far at all. That could be to do with the FCA's consultation and implementation of the new enforcement guide. And as Rebecca mentioned, is considering whether or not to make announcements using a warning list and so on. The actual most recent warning notice that's available on the FCA's website was in fact another non-financial misconduct case. That was the case of Crispin Odey, the hedge fund manager who, having been found by his own firm in an internal disciplinary investigation to have committed sexual harassment against a number of employees, decided to appoint himself chair of the disciplinary panel, fire all the people who were on the disciplinary panel, so he was the only member, and then, which he was correct about, put the disciplinary proceedings in abeyance because he had a conflict of interest between himself as the chair of that disciplinary panel and the subject of the investigation. The FCA didn't think that was good enough and did issue a decision notice earlier this year, fining him several million and so on, and effectively banning him. I think that is under appeal to the upper tribunal, so we're still waiting on a final notice in that and the UT's decision. As to decision notices, the interim period between warning and final, essentially everything that's come out this year so far seems to be the FCA cancelling various registrations and dominated by car dealers who at one stage were acting as credit brokers and no doubt, or very likely at least, as an impact of motor finance issues, which you'll all know about, are considering that's no longer something they wish to do. And then in terms of final notices, we've had 43 so far this year, 30 against firms and 13 against individuals. Some of those, of course, do include decisions arising from earlier decision notices that have been taken to the upper tribunal. So they do extend back over quite a long period of time. And that's a point I'm going to touch on in a moment. In terms of the business as usual final notices, then under the PSRs, there's various firms having their registration cancelled as small payment institutions, typically because they failed to register with HMRC under money laundering regulations, or because they failed to send their annual returns to the FCA repeatedly. And then in the case of threshold conditions, there have been 8 firms so far this year have their registrations cancelled, typically due to either not meeting the suitability threshold condition or the resources. And in the case of resources, that often tends to be a decision taken in tandem with a decision against an individual. If that individual is the firm's only manager and they have been found not to be a fit and proper person, the firm no longer has sufficient non-financial resources to meet the threshold condition because it has no approved managers. Moving on to slightly sort of bigger picture stuff, there have been final notices this year which have found 3 breaches of Principle 2 and 4 breaches of Principle 3. All of those, and this is a theme, all of those were concerned, broadly speaking, with failures by the relevant firm to identify and manage financial crime risks. The firms in question were Barclays, Monzo, Mako Financial Markets and Arian Financial. First 2 of those will be familiar, obviously, and I will come on to discuss them in a bit more detail. The latter two, Mako and Aryan, both interdealer brokers. And those decisions or those final notices do indicate the sort of reach back of the FCA's jurisdiction under the principles. The Mako case arose out of Cum-Ex trading in over-the-counter equities, and the events in question took place over 10 years ago. Mako's client, Solo Group, had been trading on behalf of its own clients billions of euros of Danish and Belgian equities. And as you may have guessed in the audience, what Solo then did on behalf of its clients was to reclaim withholding tax from the relevant tax authority. That, unfortunately, has turned out not to be such a great wheeze, as I suspect everyone in the audience knows. Mako itself wasn't conducting any of those trades, and Mako itself wasn't seeking to reclaim the withholding tax. But it agreed with the FCA, because it settled the matter. It agreed with the FCA that the manner in which Solo's trading was conducted, combined with the scale and volume, was highly suggestive of financial crime. And it accepted that it had missed red flags, including trades with no apparent economic benefit, such as trading, sort of buying the share and immediately selling it again the next day, or even the same day, without any gain other than the tax position. And it also accepted it had failed to conduct adequate risk assessments or gather sufficient information on its clients. Mako settled and agreed a 1.6 million fine. The Aryan case, as I say, Aryan is also an interdealer broker who's the subject of a final notice this year. That one may be familiar to some of you in the audience. The final notice was published this year, but following on from the upper tribunal's decision handed down in December. Aryan, similarly to Mako, had conducted, or rather accepted, trades on behalf of one of its clients who was trading on behalf of its own clients. And indeed, those trades again were Cum-Ex trades with the intention of subsequently reclaiming withholding tax from the Belgian and Danish authorities. Aryan admitted liability, but it challenged the FCA's proposed fine of around £750,000. And what Aryan said in its challenge to that fine was that first, in relation to disgorgement, the FCA had incorrectly failed to deduct commission payments Aryan had made on to a third-party company from the amounts that it had gained in commission in the first place. And at step 4, that the multiplier for deterrence of 4 times was too high. And the tribunal agreed with Aryan that the FCA hadn't correctly followed its own policy in the decision, procedure and penalties manual. And the fine was reduced from 750 to around 290,000, which might be seen as a qualified success for Aryan, subject to the payments of costs, of course, there not being any cost order. Just last week, on the 16th of July, there were 2 final notices published in respect of 2 different Barclays entities. In both cases, the matters were settled and the Barclays entity managed to achieve the reduction of 30% in its fine as stipulated in DEP. The first case on the slide, which led to a nearly £40 million fine, arose out of the business dealings of the rather colourful Mr. James Stunt, who, as I learned or possibly remembered or relearned recently, was Bernie Ecclestone's former son-in-law, previously married to Petra Ecclestone. He, in fact, was acquitted in March this year, following a 5-month criminal trial. He had been accused of laundering hundreds of millions of pounds in cash through a joint venture between Fowler Oldfield and his own company, Stunt & Co. Apparently up to £2 million in cash every day was received at the premises involved in the joint venture. And the prosecution alleged, as you might expect, that the arrangement between Stunt & Co. and Fowler Oldfield was in fact a criminal enterprise intended to launder the proceeds of crime. At trial, Mr. Stunt successfully ran a cutthroat defence. He alleged, and seems to have been accepted by the jury, that the other 4 defendants had duped him, and it was in fact they who'd stolen money and gold from him. But the other 4 defendants were convicted. Mr. Stunt was not. But of course, Mr. Stunt's acquittal was no defence for Barclays. Barclays accepted it failed to apply an appropriate level of customer due diligence on Stunt & Co, or at the appropriate times apply, as required, enhanced due diligence. Barclays had indeed rated Stunt & Co as low risk throughout 2015 to 2021, save for a period of around 14 months. And that was, as Barclays accepted, despite its awareness of the multiple risks attendant on Stunt & Co.'s business relationship with Barclays, including the very nature of Stunt & Co.'s business and the source of wealth of its founder, Mr. Stunt, who had been a personal banking client of Barclays for some time. The second case on the slide arises out of a client account held by Wealth Tech at Barclays. A trial is scheduled for September 2027 at Southwark Crown Court in criminal proceedings brought by the FCA against John Dance, Wealth Tech's former principal partner, who's been charged with alleged misappropriation of £64 million of customer funds between 2014 and 2023. He's pleaded not guilty, and I shan't be saying anything more about that. But what the notice against Barclays is concerned with is Barclays' failure to ensure it had an appropriate understanding of what its FCA authorised clients were doing and the risks that could arise. In particular, Barclays accepted the only specific check it undertook prior to opening Wealth Tech's client account was to assess whether Wealth Tech had been assigned one of Barclays' own BIC codes. Because if it had been assigned a BIC code, that would indicate it was predetermined to be eligible to open a client account. And that was the only check performed at the time of opening. As per the slide, had it taken the relatively simple further check of checking the FCA's register, it would have identified that the FCA had already imposed a requirement on Wealth Tech's Part 4A authorisation, preventing it from holding client money. That was one example of the ways in which Barclays had failed to ensure it had an appropriate understanding of its clients and the risks that could arise. Sometimes the advice to settle is relatively easy to give. Finally, Monzo. Very likely everyone in the audience heard about the large fine that was imposed on Monzo earlier this month. In essence, Monzo's financial crime controls didn't keep pace with its rapid expansion. There were wide-ranging findings, all accepted by Monzo, that it had failed in relation to due diligence, enhanced due diligence, politically exposed persons, information it collected, and so on. One relatively stark example of the impact of the failings was that apparently 2 customers whose accounts Monzo had closed due to financial crime concerns were able to simply reopen new accounts with Monzo shortly thereafter. And here's a takeaway, which is important one, I think, from the final notice. Monzo had accepted as early as 2020, 5 years ago, voluntary requirements, or VREC. Unfortunately, however, Monzo didn't always comply with the VREC. And in fact, as it accepted in the final notice, there were over 33,000 breaches of that voluntary requirement. And here's the takeaway. When calculating the fine, the FCA treated the pre-VREC and the relevant VREC period separately. It fined Monzo £19 million for the pre-VREC period at the step 3 stage. And the FCA's opinion was that was sufficiently large to be a deterrent. It calculated, following its policy, that the fine for the VREC period was only £800,000. The FCA's opinion, which Monzo accepted, was that wasn't sufficiently deterring. And the FCA increased that £800,000 fine to a fine of £10.8 million. And the takeaway being, if you agree a VREC, stick to it. Monzo was at least able to reduce the overall fine by accepting the charges at stage 1 and therefore being eligible for the 30% reduction. Finally, on the final notices that we've had in respect of individuals, there have been 8 cases concerned with fitness and propriety. As I mentioned already, often those run in tandem with firms then being found no longer to be meeting the threshold conditions. That is a case where I think we as lawyers can really assist the client in such cases. First of all, obviously, there may potentially be a defence to the relevant charges under FIT, but if it's clear there aren't, then we as lawyers can assist the firm in showing it does have other suitable managers if such other managers are available. There were also 2 cases of the Metro Bank execs who had been knowingly concerned in contravening listing rules. Tony Fox and David Price had acted recklessly with pension transfers. And finally, this one interested me in particular. Ben was talking about the read across from the SRA. Here is somewhere where I'd quite like to have been able to read across from the FCA to the SRA. I had a case, solicitor's matter recently, where there was rather interesting disposal of a firm to an unqualified solicitor, and it was quite hard to pin that on the relevant solicitors. In this particular case, the FCA essentially blocked an individual from acquiring a payment institution which was authorised under the PSRs because of the lack of information and lack of due care that the individual who wished to acquire it had given to their potential acquisition. So trends, broadly speaking, financial crime, but also the, as I say, the fitness and propriety aspects of individuals leading to potential impacts for firms. And with that, I'm going to look to the Q&A to see if we have any Q&A questions, Ina. I think that's probably one for you, Ben. Anonymous attendee asks, is it really the FCA's business as financial regulator to focus on non-financial misconduct where fraud, AML and mis-selling show no signs of abating?
So I think there's 2 parts to that question, right? One is this is the FCA's business in principle? And then the second is that sort of question people ask when they get stopped by the police, not that I know, but don't you have anything better to do? I think, right? And I think that the question is more about the second bit rather than the first bit. I hope I answered the first bit in my presentation. I think if I were the FCA, what I would answer this question is it's all connected. Look at, it's all about toxic cultures, and you have to be able to speak up. And the moment that people start thinking that there are sexual predators at large across the industry, that's the moment at which people stop using financial services in this country. So there's a cost to not doing something too. But that really, I mean, that's a hard question to answer as a barrister, right? That looks like a question about how the FCA should be using its resources. But that, look, you don't need to have written a talk about non-financial misconduct to be able to have a go at that. What do you reckon?
I mean, to me, it seems it's part of a professionalisation of financial services, in the sense that bringing in, as the FCA seems intent on doing, further parts of its own guidance, regulations, handbook, etc., which do specifically reflect non-financial misconduct, is part of making the job of being someone who sells financial services more professional. And I mean that in the sense of more akin to solicitors, doctors, teachers, etc. And if I had to answer the question, I'd say that's probably a good thing broadly. It is a policy question ultimately, and as you say, it's probably a hard one to answer as a barrister in some ways. But it does seem to me that in terms of confidence in financial services, which is something I think we can probably all agree is a good thing, capital letters, it is helpful to maintain confidence in financial services that financial services providers are seen as professionals.
Rebecca?
Yeah, I mean, I think your point, Ben, is a good one, that the moment you don't have sort of public trust in the industry is when people go elsewhere, and perhaps that might start with employees rather than consumers, but actually if a lot of employees go elsewhere to a different jurisdiction, you're then going to have consumers or customers going elsewhere too. And actually I think that it not only has a sort of moral entity, but it does have financial repercussions. If you don't have trust in the industry, as you say, David, in relation to sort of having us akin to solicitors or doctors, then if the trust goes, people go elsewhere, starts with people who work in the industry, and that follows on with consumers. So I think in terms of trying to keep financial services in the jurisdiction and keep them well respected, or even get people from outside to come and invest, then I can see why it's part of the FCA's jurisdiction.
I think I just want to add a couple more points. One is, for other professions, I don't think there's any doubt anymore, if there ever was, I don't think there's any doubt anymore that regulating this kind of conduct is absolutely within the remit. And the FCA is probably behind the curve in terms of professional regulation on that. The second point is, society has changed even in the last 5 or 6 years. This is really a response to Me Too, but it's not just I don't think it's just a knee-jerk policy response. I think expectations of the public have actually changed, and there is political and reputational and commercial fallout. And you might agree or disagree as to whether that's an appropriate thing, but I think it's a fact. There is really interesting analysis in the consultation document that was produced on the 2nd of July, going through the costs and benefits of this area. So if you want a more granular, evidence-based answer to this question, rather than us being pompous and giving you our views just because you've asked, that is actually quite a good place to look. Sorry for calling you pompous.
No, I think it's a professional hazard as a barrister. Well, thank you very much, everyone. If you do have any other questions, please do email us. But otherwise, enjoy your holidays, and please do join us again for the next in the series. I can't tell you exactly when that will be, but I'm sure it'll be sometime in the autumn. As I say, enjoy your holidays. Thank you again.